We appreciate all of the guests who have appeared on our show and sincerely thank them for providing you, our audience, with useful information. However, the advice our guests provide is theirs, and we encourage you to seek out a professional if you have specific questions about any topic we cover on the Crushing Debt Podcast. On this week's episode of the Crushing Debt Podcast, 4 drivers of the 2021 real estate market.
Welcome to the Crushing Debt Podcast with your host, Florida attorney Sean Yesner, where our goal is to help you get rid of the financial bullies in your life.
So welcome back to this week's episode of the Crushing Debt Podcast. My name is Sean Yesner, owner and founder of Yesner Law, and I have a guest on this week's show. However, before I get to my guest real quick, I do want to talk about the show's sponsor. His name is Sam Cohen. For those of you that have been longtime listeners, his company is Attorneys First Insurance, and what he does is he writes E&O coverage, malpractice coverage, basically, for attorneys and title companies really all over the country. I know that he's focusing on Texas and Florida right now, but literally anywhere in the country. So a great way to support the show, a great way to support our sponsor. If you know an attorney or title company that is looking to renew or has questions about renewing its malpractice coverage, send them over Sam's way. It is sam@attorneysfirst.com or www.attorneysfirst.com. Sam has been a longtime supporter and a longtime sponsor of the show, but interestingly, this week's guest was the very first sponsor of the Crushing Debt Podcast, and this is, by my count, his 5th appearance on the show. So you can also catch, I won't go through a lengthy introduction, you can catch him on episode 157, talking about wealth management, episode 162, talking about life insurance, episode 186, talking about 7 wealth building rules, episode 210, talking about COVID's impact on the economy. But I am happy to welcome back our friend Chris Calandra from Elliott Wealth Management Services. Welcome, Chris.
Thank you. That was a wonderful introduction. It's good to catch up with you, Sean.
Yeah, absolutely. Anytime. So we were talking sort of pre-recording here that, at least from my perspective, the real estate market here locally in Florida, in Tampa, has become the wild, wild west with all kinds of craziness going on. And I know you're now based in Florida and in Connecticut, right?
Correct. I split time between the two. My practice, Elliott Wealth Management Services, has offices in both Connecticut and Florida. I have a lot of family and friends and clients and business interests in Florida. So I'm a big fan of Florida. And you're right, it is the wild, wild west in Florida. But what we find in the United States today is that there are a lot of places where the real estate market is like the wild, wild west. Florida has been strong for a long time for some really important business reasons. But what we're seeing across this country can also be described as the wild, wild west. It's nuts.
Yeah, it is absolutely crazy. So you had reached out to me about 4 drivers of the 2021 real estate market. And so I wanted to go through the 4 of them because in looking at them, it applies to Florida and I'm sure it applies countrywide as well. So the first one that you talked about, excess money supply in the economy. What is that?
Yeah, and I think this is something that your listeners and a lot of people may not have put 2 and 2 together as it relates to real estate. The government's reaction, Sean, to the pandemic was right out of their standard playbook. That is, in a crisis, you pump money into the system. It happened during the financial crisis back in 2008, 2009. And it was done again during this recent crisis. So the government puts money into the system. The thing about it this time is that the amount of money that was pumped into the system is completely unprecedented. Just a massive amount of money is sloshing around in the U.S. economy today. How much? To put it into some context, if you have, let's say, $3 in your pocket, Sean, hopefully you have more than that, but if you had $3 in your pocket, at least one of those $3 was created in roughly the last 15, 16 months or so. So a lot of the money in circulation in the United States today came into creation over the last, again, 15, 16 months, year and a half, something like that. And so there's an incredible amount of money in the system right now. And so when you see buyers act, you may describe them as acting a little crazy with bidding up prices. There is perhaps something to that, but it is backed by a lot of money sloshing around out there that's looking for places to go. And so this increase in money supply, it's not just that people want new homes, first homes, bigger homes, vacation homes, waterfront homes. It's not just that they want it. In many, many instances, they have a lot of money too because of this massive increase in money supply. Does that make sense?
Yeah, and you may have answered the question, but one thing that I was curious about is dollars to dollars. I mean, I know there's a time value of money, and so trillions of dollars today, trillions of dollars however long ago would be, X plus today. So I guess my question is, do you know, from a comparison standpoint, if we look at how much money was pumped into the economy in 2008 for the mortgage recession, how does that compare if you were to make everything 2008 dollars, or you're going to make everything 2021 dollars? How does what we did in 2008, how does what we did in there was a recession in the 80s, the Great Depression, how do the dollars today translate if you were looking at, making them dollars to dollars comparison?
It's a good question, Sean. Even when you adjust for inflation, this pumping of money into the system versus the pumping of money into the system back in the Great Recession, which was, 10, 12 years ago, you're still by a huge factor, large increase in the money supply. It's simply not comparable, even if you adjust for inflation. It's just been massive. The numbers that are being talked about, I know this isn't a political show, but as of this recording, the Biden administration is trying to get past two major pieces of legislation, a bipartisan infrastructure bill. It's like $1.5 trillion, and the Build Back Better legislation that's some $3.5 trillion as currently proposed. Those numbers just absolutely dwarf what we saw in 2008, 2009 with the various governmental programs meant to get the country on better footing during the Great Recession. It's just massive. You simply can't compare them in any way that shows similarity. It's just huge.
So is there any way to pay all of this money back other than inflation?
Probably not. And this increase in money supply does tie into the inflation story that we're seeing in the United States today. And I'm sure your listeners are aware that we have inflation. It's been running very hot the last couple of months, the likes of which we have not seen since the early 1980s. The definition of inflation is too much money chasing too few goods. So we have increased demand as demand that was pent up during the pandemic gets transitioned, loosened up, and unleashed on the economy. So we're getting increased demand as the pandemic subsides. I know it's still with us, but it's more of a health event than an economic event, mostly at this point. And you have supply chain difficulties in this country. And so you have increased demand. You have supply troubles in many, many instances. So that in and of itself would be inflationary. Then when you overlay on top of that, Sean, the increase in money, it's not just that people are demanding goods and services. It's also that they have money. There's a lot of money out there that backs up that demand and makes it real and actionable.
Wow. So, that's one of the things that I know that inflation is more pronounced in other sectors and less pronounced in other sectors. And I have my own opinions about the media here. And I know that they like, headlines sell. So they've got to do what they've got to do. I know that inflation isn't necessarily as bad, but I think it's here. And I think we're going to have to deal with it over the next however long period of time.
Yes, I think increasingly the American public are estimating that inflation is going to be with us a while. Janet Yellen, who's the Treasury Secretary under President Biden earlier this year, forecasted that it would be 2% this year. She was completely wrong. It's going to be more like 4 or 5% this year. The administration and the Federal Reserve had predicted that inflation would be transitory, which is a fancy word, Sean, for temporary or short term. They've guided that it's going to be longer than they originally thought. And this is troubling. I know we're not talking about real estate now, we're talking about the inflation story, right. But this is troubling because it's evidence that the administration and the Federal Reserve, they're having a little bit of trouble getting their arms around inflation and controlling inflation. And the way that inflation could be very problematic is when either the government doesn't have control of inflation or they're perceived as not having control of inflation. You could have undesirable economic effects. And you see the seeds of that possibly happening. I'm not saying at this point it is going to happen, but it is a very real threat. And the governments, and when I say government, I mean both the Federal Reserve as well as the administration, it seems to me, my opinion, that they're a little bit behind the curve and they need to get ahead of the curve somehow, I think, to head off inflation becoming a bigger problem than it might otherwise be. Did I explain that okay?
Yeah. No, I think I understood it. Absolutely. The two tie so close together, real estate and the economy and all that stuff. But let's return back to the four drivers. So the first one was the excess money supply in the economy. The second one, which has also been all over the news, is low interest rates. Although interest rates are starting to tick up here as we record this, but the second driver you mentioned was low interest rates.
Yes, and I think this is somewhat more obvious than the first one, but low interest rates mean that borrowing costs are lower. That means that people can theoretically afford larger homes because their money would go farther and their payments would be smaller with such low interest rates. So we have a 0% interest rate environment now. The Federal Reserve has stated that, well, originally they stated that they would keep interest rates unchanged probably until 2023. Due to inflation and other factors, they've begun to talk about changing interest rate policy maybe in the latter part of 2022. And so low interest rates are a factor, and they are a factor not just in the way that you were talking about, Sean, and I'm talking about initially in terms of borrowing costs, but it has an impact in another way, and that is having money in the bank is very unproductive. Do people need to have money in the bank? Yes. I'm a huge believer as a certified financial planner that you want to have money in the bank defined as an emergency fund. The thing about the environment we're in, where you get close to 0%, is that it's not a good long-term place to build wealth. And I think how this is impacting the real estate market is people are opting not to put money in the bank account for legitimate reasons. You're not going to build wealth. So they're looking to deploy that money. Some of that money goes into the markets, stock market, bond market, IRAs, 401ks, that kind of thing. But I think the real estate is getting more than their fair share, where people say, I don't want to have money in the bank. What can I do with the money? And oftentimes that decision is made to either buy their first property, buy a bigger property, improve the one they have, buy a second one. But I think when you look at competition for dollars, real estate is attractive, and they're stealing market share, if you will, from bank accounts.
Yeah, and I've seen a lot of that as well in terms of a lot of people are buying cash, especially down here in Florida, where homesteads are exempt. So you can not only can you take the cash and put it into a home and have the appreciation of the property itself, but then all that money is protected from an asset protection strategy as well, like if it were an IRA, 401k retirement account versus a savings account that any creditor could potentially invade. But again, I think you're talking about interest rates generally. I do sort of see, if I'm right, interest rates are starting to tick up on mortgages a little bit.
They are. Yes, that is true. Generally, we're in a 0% interest rate environment in terms of banks, savings accounts, CDs, things like that. The mortgage market is a little bit of a curveball because of just the special nature of the mortgage market, which is tied to interest rates, but it doesn't necessarily purely follow the bank rate formula because of supply demand issues. So you're right. In the short term, we've seen a little bit of a tick up in mortgage rates. I don't think they're going to go far from where they are now, though. And it's still, by historical standards, a tremendous bargain.
Oh, yeah. It's still super, super low. And it's funny. I was thinking as you were talking, my personal checking account is just a money market checking account. And I think I get 1 or 2 cents of interest every month. So I think I report like $1 to the IRS because it's easier just to say whatever. So anyway, so number 1, excess money supply in the economy. Number 2, low interest rates. Number 3 was interesting to me when I saw it. Stay-at-home economy. I know as we're recording this, I'm at home right now. I'll probably be going into the office right around lunchtime, but stay-at-home economy.
Yeah, so this has been talked about in terms of how business is changing, and more people, even before the pandemic, were working from home. And then the pandemic very much accelerated that trend. I think most people would agree that the world has changed and people will work more remotely to a much larger degree than they did in the past. How this affects real estate, in my mind, Sean, is that it's led to people making economic decisions in terms of having a greater appreciation of their home and wanting to beautify it during this pandemic and this stay-at-home economy trend. So a lot of people have chosen during this period to improve their home, build a bigger patio, expand the deck, have a nicer home office, beautify the master bathroom. A lot of money that has gotten reinvested into their homes. And part of that was to increase their enjoyment, because a lot of people in this country ended up spending more time at home than they ever did before. I fall into that category and still do today. So they wanted to improve the place that they were spending more time. And this was rewarded because as prices went up, it not only became a decision-making rubric that said, I want to improve the place I'm spending time, it also looks like a good investment too, because I'm getting a good return on that investment as I see the value of my property go up. And it becomes a little bit of a virtuous cycle. As you want to improve your property, it drives the value higher. And then you might want to do a second round that drives the property higher. That kind of self-fulfilling prophecy is very much in play now. And so the home upgrades, and I know we in my house, my wife and I, we've done some upgrades to the house during this period, and we've been rewarded for it with an increase in value. So that is how the stay-at-home economy is affecting the real estate market. Secondarily, and you touched on it a bit, is you see tremendous demand for vacation homes, second homes. And I think this is very pronounced in Florida, where a lot of people in the Northeast and the upper Midwest are buying properties in Florida, which has been a trend that was going on for a long time. It's just gotten strengthened and accelerated, but they're buying second homes, vacation homes in Florida, and they often are buying it from a strong position where they either buy for cash or put large amounts of money down. So they're not really strapped and aren't stretching to acquire the properties. Of course, I'm talking in generalities, Sean, but you see that stay-at-home economy, that demand for vacation and second homes, figuring that if I have to work from home, I could work from my home in New York City or from my property in fill in the blank, Florida. I think that has had a big impact as well as part of this stay-at-home economy trend that's helping drive the real estate market higher.
Well, and So when I first read that comment, about the stay-at-home economy, I had two other thoughts as well, and one of them was the impact on the commercial market. I mean, again, I look at myself. We just expanded the office. We were a little bit jammed up for space, busting at the seams. We went to a bigger space, but not a much bigger space. And now, if I'm thinking about potentially expanding again and adding either another assistant or another attorney or whatever in 2022, but I'm out of offices. However, with the ability to work from home, having an office, having a commercial space, I mean, I feel like I need to because I'm a little traditional. I'm an attorney. I need a space to see clients and sign documents and do all that kind of stuff. But at the end of the day, I could be a law firm of 4, 5, 6 people and all of us work from home. So I think it may end up having a negative effect on the commercial market because less people are looking for office space. The other thing that I thought on the residential side is, I remember growing up, it was my mom and dad and me and my sister, a family of 4, but we had a 3-bedroom house. I had my bedroom, my sister had her bedroom, my parents had the master bedroom. Now you look, I've got, a wife and 2 kids, 4-person household, but we've got a 4-bedroom house. And the bedroom I'm in right now is the home office, and there's a pull-down bed on the wall for when guests come and stay. But I think what I'm also hearing on the residential side is more people are looking for that spare bedroom or spare bedrooms. I need one bedroom for my office and one bedroom for my wife's office. And so I think that's driving real estate as well.
Yes. And again, this is a trend that accelerated through the stay-at-home economy, through the pandemic. And I agree with you, but you look at the average square foot of homes now compared to in generations past, Americans want bigger homes. And with this idea that I'm going to be home more and I'm going to be working from home more, either exclusively working remotely or at least part of the time, you want to have a dedicated space for that, a nice space for that. That often means that you want a little extra space, and you wouldn't want to necessarily work out of your bedroom. If you could afford it and it fits into your financial situation, a lot of people are choosing to have more space, not less.
Yeah. Although, interestingly, I find myself, so I've decided that I'm going to work in the office Monday through Thursday, exceptions like this notwithstanding, and then work from home on Fridays. And I don't know if it's Friday or that I'm home, but I always tend to be a little less productive on Fridays than I do Mondays through Thursdays. So I don't know. It's either that I'm home or that it's Friday, one of the two.
You realize this is being recorded, right?
I know. So for the clients listening, I'm very productive on Fridays. I get more done on Fridays than any other day of the week.
I love it.
Yeah, or Saturdays or Sundays, whatever. So again, the excess money supply in the economy, low interest rates, stay-at-home economy, and then the fourth one, which we've experienced, although it's leveled off a little here in the Tampa Bay area, but a limited housing supply. I mean, I remember back at the beginning of the year, a house would go on the market at noon, and it would have 50 offers by 2:00 in the afternoon. And a lot of them, I may be exaggerating a little bit, but a lot of those were sight unseen. And I've heard stories of no inspection periods and buyers doing all kinds of crazy things just to get their offer at the top of the list. I've seen sellers back out of selling because if they do that, they don't know where they're going to buy because there's nothing to buy. So that fourth point you talk about, the fourth driver of the real estate market, the limited housing supply.
Yeah. So there's a couple of layers to that. The most obvious one is that there's a shortage. There's more buyers in most markets in the U.S. than there are sellers. So there's an imbalance. And when you get an imbalance like that, where demand is greater than supply, basic economics is you're going to get price increases. And so I think another layer to that, and I think this is very evident in a lot of the Florida markets, is that there's not just a lot of demand, not enough supply, but when you look at it, it's not like somebody is buying a property and they have a corresponding sell. A lot of what's getting purchased are people that have something maybe elsewhere and they're not selling anything. So they're not adding to supply. They're only taking away from supply. A lot of the transactions, and I think the Tampa market falls into this category. By the way, I'm looking to buy a place in Tampa, so I follow this very closely, is that it's not like I'm going to sell this so I could buy that. It's that I want to buy that and they're not selling anything. A lot of outside people coming into Florida wanting to buy vacation, second homes in Florida, they're not adding to supply. They're just taking away from supply. And in certain markets like yours, I think that is having a noticeable impact in the supply imbalance, meaning it won't be easy to get it in balance because there's even fewer sellers than you think because there's just buyers who are not selling anything. I explain that okay?
Yeah, that's an interesting perspective, and it makes sense. I hadn't really thought about it before. The interesting offshoot of that is, back in the day, I did a ton of short sales, and I think I have one, maybe two pending right now. But the other interesting thing that's happened because of the limited housing supply, number one, short sales have, for all intents and purposes, gone away. But the other interesting thing is I have clients from that engaged me years ago, pre-COVID. When COVID hit, we had all the foreclosure and eviction moratoriums. Now those are ended and foreclosures are starting to fire back up. But the interesting thing is, where we were in a negative equity position before, now these same homeowners are in a positive equity position. I had a guy who was barely at break even. He had a high six-figure value house, and he was barely at break even when I started representing him 2.5, 3 years ago in his foreclosure lawsuit. He just sold his house and I think made about $250,000 of profit from the sale of the house because the limited supply and the increased demand, and drove up the value of the house so much that he went from a negative or break-even equity position to a positive. So I think we're going to see a lot more foreclosures coming. I don't think it's going to be the wave that people predicted, but I think we're going to see a lot more foreclosures coming. But the interesting thing about that is we'll be back in the 2001 to 2005 range where people can sell their house or even potentially refinance their house because they now have equity in those houses again.
You bring up a great point. I know there are some people out there, especially real estate investors, and I know you work with a lot of real estate investors, believe that with the eviction moratorium eventually ending, I'm not sure when that'll be, but that you're going to have this increase in foreclosures and short sales and distressed properties, that's going to turn the tide and create some bargains in the marketplace. I am not in that camp. I do not think there'll be enough of that to stem the tide of this trend. And I think that if you're waiting for that to happen so that you'll be able to get bargains and be able to swoop in and get really discounted prices, or even have a reversal of this where you see big drop in home values, I don't see that happening. I'm sure in the country there'll be some locales where that does occur, but in the main, I think in Florida in particular, you're not going to see that. I think that that camp will proven to be incorrect.
Yeah, and that was going to be one of my last questions is, do you see a repeat of the bubble that we had that caused the Great Recession back in 2008 to 14? Do you see a bubble forming?
I do not in real estate. Of course, sensing bubbles is a tricky proposition, but I don't. And one of the key factors is that when you look at lending standards in this country, they are still very high. If somebody goes to get a mortgage today, the lending standards are very rigorous. This is very different than what it was like in 2006, 7, and 8, where banks and mortgage companies were giving out mortgages to people that shouldn't get mortgages, on valuations that they shouldn't lend on terms they shouldn't agree to. You're not seeing that. You're not seeing that at all. And you touched on it earlier in the conversation. I think, Sean, you said something like, you're seeing so many cash deals. I think when you look at the vast majority of deals that are being done, the buyer, in part because of the increase in money supply and in part because of the low interest rates, are very strong buyers. They're buying with cash or they're buying with lots of money down. When I think of people that I know that have bought properties recently, we might question whether they bid up the price too much. We could debate that. And in some instances, maybe people overpaid. But when you look at underlying financial strength, their ability to get a mortgage, their overall financial standing, I believe that the vast majority, enough of those deals, those people have enough financial wherewithal that they're not fragile owners where if you had a little bit of a decline, it would create a lot of tumult in the market. And I think those are two prime examples why this is quite different than the run-up in the 2004 through 2007 era that led to such a disastrous outcome. I just don't see it. If it does happen, Sean, it will be for very, very different reasons than the time before. But I just don't see it with high lending standards and with buyers, by and large, being pretty strong buyers.
Okay, well, before we wrap up, so again, the four drivers for the real estate market, the 2021 real estate market: excess money supply in the economy, low interest rates, the stay-at-home economy, and a limited housing supply. Anything that we missed? Anything that you wanted to add?
Yeah, I'll add two quick things. Is with that limited housing supply, keep in mind that this is something that has been building up for a very long time. We've mentioned a few times the Great Recession, but the U.S. probably was in a deficit each year since the Great Recession in terms of how many homes need to be built to meet demand, like population growth, and a certain amount of properties come offline, fire, obsolescence, hurricanes, floods, things like that. I looked at some really great research from a company called First Trust, and their chief investment officer is a guy named Brian Westbury. I'm a big fan of his. And the research that they put together shows that we've been running a deficit each year for the last decade, where we need about 1.5 million new homes, but we've only been creating about 1.25. So this supply constraint that we're experiencing now, this didn't just happen, Sean, because of the pandemic. It's been a confluence of events. But one of the things that I think goes overlooked is that this was a long time coming. And the pandemic and everything transpired created this magical time where you have this, again, confluence of events. But we've been running a deficit in new home construction since probably 2006, according to this impressive research. And so it's not surprising that we're experiencing this limited housing supply. And it also points to the fact that it'll take a little while to get back to equilibrium because of this deficit that built up over quite a while.
Yeah, that's an interesting perspective. I hadn't thought of that, but it makes, I didn't know that, but it makes a lot of sense.
Yeah, and I think probably Florida is not as guilty of this as like in Connecticut, where I reside. You know, the real estate market for a while in Connecticut was much more stable. I mean that as a negative, right? The prices didn't really go up much after the Great Recession. So we didn't create much new housing in Connecticut compared to like Florida. So now with the pandemic, we've seen big price increases in Connecticut, like you have in Florida. But I think it's more a function of we hadn't been building. Florida's a little different because of the demographics. So many people wanting to be in Florida, either full-time or part-time. All that business creation and business relocation. You guys just have a stronger, more resilient economy than some other states, including Connecticut. But yeah, that shortage is important. Probably not as much in Florida, though.
Well, one of the other interesting things about Florida is, you know, where in Pinellas County, which is Clearwater, St. Petersburg, Pinellas County is a peninsula on a peninsula. So there isn't much land left to build on, if any. I don't think there's any land left to build on, really, in Pinellas County. You look at, Tampa, which is Hillsborough County, there is land to build new homes, new communities, new whatnot in Hillsborough County, but it's starting to spread away from Tampa because you're starting to go out more into the rural areas and sort of create those developments. And so that, I think, is also an interesting factor.
Yeah, I would expect the metro Tampa area over the next 10 to 20 years will be larger geographically than what you've experienced having lived in Tampa for quite a while.
Yeah, and it's a pain in the butt to go over the bridges. So I do want to give out your contact information real quick. So again, it is, if you want to go visit the website, it is elliottwealth.com. And if you want to email Chris, it's ccalandra@elliottwealth.com. Again, Chris has been a guest on multiple episodes, and so you can find his information in those episodes. I'll also put the contact information in the notes for this episode. Anything else, Chris?
No, I'll plug my podcast, though, which you've also been a guest on, Simply Financial. It's on all of the major podcast platforms. I put it out each week. I'm in my sixth season coming up soon. So people could check that out as well. I do a lot on the real estate market as well as other economic and financial educational topics. So Simply Financial with Chris Calandra.
Yeah, and wherever you're listening to this show, you can listen to Chris's show, and I recommend it. My episode is clearly the best one, but overall, it's a tremendous show.
A distant second, if you will.
So, I think that'll wrap it up for this week's episode. Thanks again, Chris. Episode number 5, repeat guest for the 5th time. So thank you again for being a guest on the show.
Thank you, Sean. It was a pleasure. It was wonderful catching up with you and a really great discussion. I hope and expect your listeners will get some value out of the information we exchanged.
Yeah, absolutely. I always enjoy talking to you, and the information is tremendous. So I will wrap up by saying, like I do at the end of every episode, I hope that at the end of the month you have more money rather than at the end of the money you have more month. That'll do it for this week's episode of the Crushing Debt Podcast, and we look forward to talking to you in next week's episode.
If you have questions that you think would make a great topic for a future episode, please email Sean or connect with us on social media. Sean Yesner and Yesner Law, PL, are Florida licensed attorneys. The information contained in this week's episode is not a substitute for legal advice. Your situation may differ, especially if you are located somewhere other than the state of Florida. If you have questions, please contact our office or contact a local attorney. Thank you for listening to this week's episode of the Crushing Debt Podcast.